So a very good evening to everyone. I'm 𝗍𝘃𝗀𝘁 from FSMOne. So welcome to this evening webinar. Global technology and global equities continue to be core positions in your portfolio. So the first half of 2024 is ending soon, and while the Fed has not cut any rates as we expected, the market is definitely not a quiet one. Against a robust economic backdrop, the earnings outlook for the market is expected to improve through 2024 and possibly through 2025 too. And unsurprisingly, leading the pack is the technology sector. So while growth may moderate gradually, it's hard to turn away from the stellar performance of the global technology and global equity sector. So I guess the question now is, should we continue to hold important positions in our portfolio, or has the fairy tale ended? So this evening, I'm privileged to have a host of speakers to tackle the question. First up, I have Leonard Lee, Sales Manager of Intermediary Sales, Fidelity International. He will present on the opportunities that the technology sector offers. Over to you, Leonard.
Hey, thanks very much, 𝗍𝘃𝗀𝘁. So first of all, good evening, everyone. Thanks very much for sharing the next hour or so with us. So I have both the privilege of starting us off tonight's session and also the stress of trying to wrap up my presentation before Nikko AM takes over. So let me try to keep my presentation short, and more importantly also, I hope to leave at least 10 minutes or so from my segment to answer any questions that you all may have with regards to the tech sector. So no surprises. Today's segment is all about discovering the winners of tomorrow, and what I'll be focusing on is really on the topic of tech investing with Fidelity. So maybe let me just open off first with a quick introduction to Fidelity International, so who we are and what it is that we do. So we are a global asset manager. We have over 50 years of heritage within active asset management, and I would say a key point to highlight is how we are a privately owned company and investment management is our only line of business. In terms of the assets that we are currently managing, it's close to $800 billion, and most of it are going to be within the actively managed space. And that is also because we believe that research is going to be our competitive advantage. We rely on our research network to really lend us the best insights and ideas into finding which are the best stock opportunities that our portfolio managers can put into their portfolios. And this is also pretty much why we like to say that here at Fidelity, we are known for our research platform, and that continues to power our investment decisions. And specific within the tech sector, that is all the more important, especially when navigating such an exciting and constantly changing environment. I would say that this is again one of the key differentiators for why we have been able to position our strategy very uniquely in an otherwise crowded space. So recently also, we came off the Oscars of the asset management industry. So what you can see on this slide over here is really the accolades and awards that we have garnered, both at an asset manager level and also across a number of our flagship strategies, cutting across multiple asset classes, multi-asset, Asian equities, fixed income, and even sustainability. So in terms of the industry recognition, I think we have firmly established ourselves as one of the leading asset managers out there. So maybe let me jump straight into my presentation proper, and I'd like to open with this slide over here. So it's nothing more than a slide of showing you how this particular person wants to be long deja vu. So I'm sure if you are following the markets, you've been following the headlines recently, there has been a lot of talk about markets hitting all-time highs. But if you think about it on hindsight, the market has always hit or experienced an all-time highs. And if you believe the longer-term trend of the markets is to go higher, and if you believe that growth will continue to power a lot of the solutions that we are seeing out there, then the saying goes very true, that there is no time better to invest in than yesterday, but otherwise the next best time is going to be today. And within the tech space today, I would say that the odds are very much with us. Tech is now an unstoppable force, and we continue to see how it's transforming the way that we live, we work, and we play. And it's going to be cutting across all industries and all sectors. So this is also one of the reasons why I would say we are quite excited to be speaking about tech, because when it comes to investing, you want to be looking for growth opportunities. And this is a space that is only beginning to see the start of a major transformation. So looking at the market backdrop, if we take a look at the markets, of course, it has been a tale of two halves comparing between 2022 and 2023. 2022 was a pretty tough year for you if you were investing within the tech sector. We saw sharply rising rates really weighing on the overall markets, and we saw how the tech sector had actually led losses in that year. 2023, on the other hand, was very much a different story. But what we saw was a very narrow market rally. So in other words, it was really being led higher by what was known as the Magnificent Seven. So these are nothing more than your mega cap tech companies, the names of which we are very well familiar with. For example, Nvidia, Apple, Microsoft, and the likes. So in 2023, it was a very narrow market environment that was led by these few names. And 2024, we continue to see this music sort of continue, but we are starting to see some nuances come through in the way that the market has been moving. We are starting to see some divergences across the Magnificent Seven. It is no longer a story about how it's a tide that will float all boats. And this is actually one of the reasons why we say that although the overall backdrop looks to be positive, it is getting even more important for investors to be selective about where they want to put their monies in and which will be the best ideas to lead us in the next economic cycle. So just to put the case in point, what this slide over here really shows how these Magnificent Seven stocks have performed versus US equity markets and also the broader global equity markets. And what you can see is that the picture does speak for itself. The Magnificent Seven has been powering higher and defying gravity, whereas if you strip these out, the S&P 500, the global equities market, things do not look to have moved up as drastically. Right-hand side of the chart, this is where we look at the valuations. So this is represented nothing more than price to earnings ratio, just to sort of see how expensive stocks look relative to history, relative to other peers. So what you can see again is that on the valuation side of things, it is also painting a similar story about how the Magnificent Seven stocks are trading at more expensive valuations compared to the S&P 500 and also compared to the broader global equities market. So something that is quite interesting to point out also is that when markets move across different cycles, what we see is typically the market sort of a rally would be led by a very narrow parts of the market. So only a small part of the broader market would be moving higher. And subsequently, over time, that's when you see the market rally broaden and you start to see other companies participate in the market rally. So what you see on this chart over here is that in 2023, that was exactly the kind of market cycle that we saw. It was the start of it where you are seeing very select handful of stocks pulling the markets higher. But one of the key themes that we are seeing playing out in the market right now is a potential broadening of the market rally. So this is also one of the reasons why we say that if you are investing in tech for the longer term, you want to be looking outside of these parts of the market that are starting to look crowded, that has also gone up quite a bit. Because as the market rallies, you are going to see some of these other companies outside of the Magnificent Seven start to benefit from the broader market kind of a rally. So in terms of valuations wise, again, if we just look at price to earnings ratio of the IT sector, it does look to be trading at a premium. So in other words, IT stocks on average do look to be more expensive than the broader market. But if you think back to the what I mentioned just a few slides ago, where a lot of this rally has been concentrated within a handful of names within the mega cap tech sector, if you discount and peel back some of these layers, actually there's a lot more opportunities out there for the investor to sort of discern through the different market noises to really spot for some of these opportunities that are actually still trading at reasonable valuations. And that is also one of the things that we are looking for in the way that we are navigating the technology space today. So I mentioned previously that here at Fidelity, we do leverage our research platform a lot. So our analysts out there engaging with companies, these are the ones that we rely on to sort of give us a view on where are the opportunities and also risks out there in the market. So when we recently took stock of their sentiment towards the different sectors that they are covering to sort of see where are the places that they are most optimistic about earnings growth, no surprises over here. They hold the most constructive view towards communication services and IT, which is a very big part of the tech sector. And if you think about it, it's quite natural that this is so, simply because when we look at tech today, the rate at which the tech sector is really powering higher is at an astounding rate. So for some of you who are very much familiar with tech, there's this concept of Moore's Law. What we see with tech is that the expectations continue to accelerate. And if we take a look at some of these familiar names that have transformed the way we are engaging in the way that we live, we work, or we play, for example, Netflix, the way that it has transformed media and the way that we await some of the latest releases to come out. We saw how Netflix took about 1,200 days to achieve 1 million users. Other names, for example, like Facebook, which is the way we stay connected with friends and family, took them about 300 days to reach 1 million users. iPhone itself took about 74 days, and more recently, we had ChatGPT, and it took them just 5 days to reach 1 million users. So if you're talking about the opportunity for growth within the tech sector, that's the sort of exponential rate that you are looking at. And that's also one of the reasons why we think this is an exciting space, if you are a growth investor, to really look to capture some of these transformational trends. So something else that we like to highlight also is how when you're navigating the tech sector, don't just think about software or hardware, and don't just look at the recent sort of a tip of the iceberg. For example, generative AI, your FANG stocks, or today the Magnificent Seven. Tech today is going to be cutting across multiple industries and multiple sectors. So something that we try to do when navigating the tech space is to look under the surface, to look across all industries. For example, within the traditional finance space, even the way that we are making payments today have transformed. It's about contactless payments. If we look at the way that we are engaging with gaming as well, we had video gaming, and now with the advent of augmented reality, Apple Vision Pro, this is only going to open up new ways for us to engage with gaming. So across different sectors, even within the energy and industrial sector, there are also tech solutions that are transforming these otherwise older sectors. So we want to look across all these different kind of opportunities, because tech today we think is really everywhere. So if we take a look on this slide over here, I thought it would be quite useful to also take stock of artificial intelligence, given this is the latest sort of hype that you're coming across in the media almost every single day. So within AI, what we like to say also is that people tend to be focused on the latest darling of the market, which is NVIDIA. But actually, artificial intelligence goes beyond NVIDIA. It is a full ecosystem. It's a full technology stack. You don't just have NVIDIA, which is really responsible within the design of some of these components, but you also want to be looking for some of the other companies that are supplying components, that are manufacturing chips, that are also powering and enabling artificial intelligence. So other than NVIDIA on this slide over here, you can see on the left-hand side, a number of other names, for example, TSMC, Samsung, that are also foundries, that are also enabling this artificial intelligence trend. In the middle part as well, data is a very big part of artificial intelligence, and that's where you see how companies today are leveraging cloud. They are leveraging data management services as well to try to bring about a competitive edge in the way that they execute their businesses, be it for advertising or to enhance their products and services. So even within the data infrastructure space, there are opportunities for you to look at. Last but not least, software is how we interact and create end user solutions. And this is where you can see some of these names represented over here, names that are not too alien, especially in our everyday lives. But these are also examples of how we can participate in the AI trend without simply chasing after the most crowded stock in the market. So if we take a look at some of the areas of opportunities that we are watching for within the tech sector, very simply, two key areas. One, we want to be looking away from the tip of the iceberg. We want to be looking at the smaller to medium-sized company space, because these tend to be overlooked by the market, and it gives us quite good M&A opportunities, for example, when these are acquired by larger companies. More importantly also, we want to make sure we are balanced and diversified. We want to look across all sectors, not just within traditional software and hardware. We are looking across even the traditional sectors of energy, industrials, to find some of these innovative companies that are involved in digitization, that are involved in transforming their business. Ultimately, investing is also about taking note of some of the risks that are out there in the market. So AI today, while it is a hype, we also want to be wary about where are the crowded parts of the market that are trading at more frothy or lofty valuations. So this is where we are a little bit more cautious about the parts of the market that run up a lot. We want to be looking at other parts of the ecosystem that can likewise give us exposure to the AI trend without taking on too much risk about chasing the more expensive parts of the market. There are also some shorter term opportunities that are playing out as we speak. So one key example would be smartphone industry. So I would say if you take a look at how we have been managing our smartphone renewal, so how often we are changing our handsets. Once upon a time, it used to be every 12 months, 24 months during the era of Nokia. And today, what we see is that that cycle has lengthened. Today, people are changing their phones maybe on average about 3 to 3.5 years. We see ourselves coming into the start of the next smartphone replacement cycle, and this is where we can participate in the upcycle of smartphones by buying some of the companies, or rather investing in some of the companies that are producing components that flows into smartphones. So this would be a nutshell, some of the key areas that we are watching within the tech space. So just to bring it all into action, into how we are navigating the tech space with Fidelity Global Technology Fund. So just 4 very key sort of features that we have within the strategy. The first is going to be talking to a time-tested approach. So this is not a new strategy, not a new kid on the block. This strategy has been live since 1999, and our current portfolio manager has been managing this since 2013. So more than a decade of navigating different market cycles, and we have been able to return very attractive returns versus both the index and also versus our peers. Something else to point out is how we are backing this up with the strength of Fidelity's research platform. So other than the portfolio manager, we have the rest of our research network lending him insights, navigating the smaller to medium-sized company space to give us insights that you can't otherwise get just by reading annual reports or disclosures. So this is actually one of the reasons why we have been very successful in identifying some of the winning companies of tomorrow. Third point over here is how we tend to be a little bit more contrarian. So this just means we think very different in a crowded space. So what we notice is that investors tend to chase after a select group of stocks, and this tends to expose us to quite a bit of risk. So being contrarian means we can balance our portfolio more by simply not chasing after the most crowded parts of the market. We have a very strong valuation-based approach as well, which also means we will not overpay for stocks at all costs. And this has given us our ability to protect very well on the downside when markets are correcting very quickly. Last but not least, holistic portfolio construction. When you are investing via a fund rather than stock picking, you want to see balance, you want to see diversification. And what you can see is that we typically balance our portfolio across 3 major sleeves. We have the long-term growth winners. We have some of the shorter-term cyclical opportunities, for example, smartphone replacement cycle, the semiconductor cycle. These are areas that we are trading in and out quite actively to try to capture some of these near-term movements. Last but not least, special situations. Finding some of these smaller companies that eventually gets acquired by the larger ones. This gives us very good alpha, especially across different market cycles. So performance-wise, as you can see, thankfully it does speak for itself. The fund in the blue line has been able to keep in pace and even outperform the index, and we are well above the sector average of the average tech fund out there in the market. Right-hand side chart, you'll see how we have been able to deliver more impressively higher returns with lower volatility, and this trumps the sector average by far as well. So this is going to be the face behind the strategy. So this is none other than 𝗠𝘆𝘆. Today, he has all his efforts focused on just running this one single technology fund. It is one of the largest funds out there in the market as well, with AUM of over 21 billion US dollars. So I would say in terms of just articulating or sharing rather, what are the 3 key things that are sort of differentiating our portfolio right now and why we think we are perfectly positioned for the current market environment. One, I mentioned about crowding. I mentioned about how we want to participate in the broadening of the market rally. We have less exposure towards the Magnificent Seven. Peers tend to sit anywhere between 25 to 35% of the portfolio. Today, our exposure sits at around 16%. Smaller to medium-sized companies, not the majority of the portfolio, but we have a meaningful exposure of around 18 to 19% today. That gives us some good alpha opportunity from there. More importantly, also, I spoke about cutting across the iceberg. We want to make sure we capture the full spectrum of opportunities in tech. So we are not just looking at the IT sector, we are going to be looking at consumer companies, energy companies, industrials companies that are also very much powered by the tech trend. Last but not least, in terms of outcomes for investors, our valuation-based approach means we have been able to defend very well on the downside. For example, 2022, when markets are down around 30 to 33%, we were able to cushion about 1/3 of the downside. We closed the year at around minus 22%. Many of the other growth-oriented peer funds were down anywhere between 30 to 40%. So I would say I'm wary also about time. So maybe let me just touch on quickly about some of these kind of trends that we are seeing also. So something that we are looking at are also going to be longer term growth opportunities. So what you can see on this slide over here are going to capture some of these storylines that we are well familiar with. 5G continues to play out. We see a build out of the infrastructure. We see telcos continue to power ahead with 5G solutions. AI, of course, that will be the latest hype on the market. Transport as well is changing. We see how electrification of vehicles is very much a real thing that's transforming the roads and cars as we know it. cloud and infrastructure, end of the day, this is the backbone of the tech infrastructure. This is only going to continue to grow, especially as more companies are adopting artificial intelligence and embedding data within their everyday businesses. On the right-hand side, these are slightly more tactical opportunities. For example, within the Chinese internet space, within the China tech space, we see how there's a strong commitment to build up some of these strategic capabilities. We are a little bit more watchful of being selective in this market. Last but not least, digitization. This is really all about capturing opportunities, transforming multiple industries. So these are really the few storylines that we are expressing within our portfolio to give you some sort of exposure to these longer term trends. So I can't mention stock-specific examples, but what you can see on this slide over here are really 3 stock examples that we have within our portfolio. We have an energy sector kind of a company, but this is not really involved in the oil and gas industry. This is pretty much about finding digital solutions, delivering digital and data analytics solutions to the rest of the oil and gas sector to try to give them tools to monitor their business, improve efficiency. And with the transition towards a cleaner and greener world, this is an area of structural growth that we are participating in. In the middle, this is going to be an aircraft manufacturer, aircraft turbine manufacturer. So what we think differentiates them is how they have embraced artificial intelligence, digital solutions within their product, and they're actually collecting flight time data from all their turbines to customize the maintenance schedules for their end clients. So this is something, again, that we think differentiates them from its peers and how they are embracing tech to achieve a competitive advantage. Last but not least, within the gaming industry, we do hold some of these leading gaming companies. So this example over here holds a number of these well-established franchise names, for example, FIFA, Need for Speed. So again, another example of how we are finding an area of opportunity that investors tend to overlook in their own portfolios. So performance-wise, I briefly mentioned, it does speak for itself. So we have been able to deliver pretty consistent returns. And right now, since inception, we have been able to deliver around 18% of annualized returns. 2022, good example of how we were able to defend around 1/3 of the market drawdown. 2023, despite being more balanced and diversified and not simply chasing after the momentum-driven stocks, we were able to largely keep pace with the market. We were up around 44% in that year. So sectors-wise, again, what you can see is that we are looking outside of the IT sector. We are finding opportunities across consumer companies, industrials, financials, real estate, and even energy. And country positioning-wise as well, what you can see is that we are not just focused on the US. A lot of investors tend to just fixate on the well-known US tech companies. For us, we take a more balanced approach. We have around 55% of the portfolio invested in the US right now. We are going to be looking across the world for opportunities that are trading at attractive valuations, opportunities in leading companies as well that are supplying the world in Taiwan, in Korea, and also the rest of in some European regions as well. So top 10 holdings, this is where I can finally draw attention to some single stock examples. So what you can see over here, we are holding onto very well-established companies with the likes of TSMC, Microsoft, Apple. And something else to point out is if you look at our single stock positioning over here, we are not going to be like some tech funds that are close to 9 to 10% allocated towards a single stock. We take a much more balanced approach. Today, the top stock holding that we have is sitting just over 5% right now. So I think that is really what you can look to expect with our portfolio. Today, we are diversified across 97 stocks. And in terms of AUM, I mentioned we are one of the largest, if not the largest tech fund out there in the market at around 21 billion US dollars. And if I were to just leave you with 3 key takeaways before I move on to answer some of the questions that have come through, I would say if you are investing for growth, you want to be looking at the parts of the market that are involved and backed by structural tailwinds. And today, that is going to be the tech sector. And tech today is no longer just about software or hardware. It is going to be cutting across multiple sectors and industries. So you want to be looking for a strategy that is able to find these opportunities for you. And more importantly, in today's markets, don't just look at the Magnificent Seven. Participate in the market broadening, in the market rally broadening by looking for opportunities outside of these Magnificent Seven, for example, in the smaller to medium-sized company space. And last but not least, look no further than Fidelity Global Tech Fund, because what we are going to be bringing to you is a time-tested approach of delivering steady returns, backed by our extensive investment resources, the ability to think different in an otherwise crowded space, and last but not least, balanced and diversified in the way that we construct our portfolio, in the opportunities that we are finding for end investors as well. So if I were to just leave it on this last slide over here, the question is really, what do you see? So let me just leave this on as a background before I move on to answer some of these questions over here.
Right. Thank you, Leonard, for the wonderful sharing. So for participants and so far, attendees, feel free to leave your questions at the Q&A box. I want to emphasize that due to time constraint, we are unable to answer all the questions. So Leonard, I shall leave the Q&A to you then.
Okay, I'll try my best. 5 minutes and I will not steal the thunder of Nikko AM. So maybe the first question I see is about whether or not we invest in China. So yes, we do. We do invest in China. And if you can see on this slide over here, we have roughly around 6% of the portfolio that is directly exposed to China. So I can't quote specific stock examples, but what I can share is that for China, given the volatility that we are seeing over there, we want to be a lot more selective in terms of where we are putting our monies in. So this is where we are not just buying a broad-based basket. We want to be selective about the companies we are investing in. So we are looking for some e-commerce companies that are involved in travel as well to participate from the cyclical recovery. So this is something that we are doing with China. We are also managing our absolute exposure given the sort of geopolitical environment that we're in. So otherwise, direct exposure to China is sitting at just around 6% right now. So another question over here is about cybersecurity and biotech, whether it's part of our mandate. So I think the beauty of tech is that a lot of these trends are not just consigned to companies that are delivering you cybersecurity solutions or even biotech, because end of the day, a biotech company is also going to be embracing some data analytics software. They are also going to be leveraging on cloud providers to power some of their business data as well. So while we may not have any direct impact, exposure to some of these more niche themes, biotech as well is quite a binary space for you to be in because drug trials may or may not be passed. So I would say that how we play it is really via the broader kind of a tech team. So these are also going to be likewise powering some of these sub-themes that you are seeing over here. So I see quite a good question over here, which is about market performance. And if it's going to be largely in line with the index, then what is the case for looking at Fidelity Global Tech? So I think something to sort of point out is that we have seen a pretty interesting last year and a half or so since 2023. What we have seen is a continuation of the music, like I mentioned, mega cap tech stocks continuing to pull the market higher, a name like NVIDIA that's gone up about 250%. So what you can notice with our fund is that in specific years, for example, in 2022, when we start to see things not as rosy, when we start to see that very sharp correction, you want to be able to have a portfolio that is aware of valuations that are not just buying expensive names that have a huge downside. For example, 2022, NVIDIA started the year at around $300 odd, and then we saw how with the sharp turn of the markets, it went down to about $120, $130. So things can change very drastically, and you want to have that sort of discipline. And that is also one of the reasons why our portfolio was able to defend very well on the downside. If we take a look at when the index had caught up, it was a year like 2023. It continues to be year to date because NVIDIA continues to pull the market higher. So if you sort of see the view that over market cycles, new entrants come in, companies come in and out of the picture, you want to be able to navigate it very actively. So while ETFs may look optically, it looks like it tracks the market well, but you want to also have an actively managed fund because that will be able to find you some of these opportunities in the smaller to medium-sized company space. You want to be able to actively manage your downside risk when markets are correcting. So I hope that makes a strong case for active management over here. So I think let me try to answer one last question before I hand the time off to Nikko AM. So I think this question is about when do we see a major market correction or recession kicking in? And I see a couple of other questions relating to maybe forward expectations of where we see ourselves. So I think one of the key things is that this is a crystal ball question, but we do think that markets are going to be quite benign for now. We do see how earnings continue to be quite healthy. And I would say within the tech sector, if you look at and monitor some of the earnings results that have been released releasing, the tech sector is actually one of the best performing sectors when it comes to delivering results and beating expectations. So if we take a look at the trend right now where every company is trying to embrace data, where every company is trying to find some tech solutions to keep up with the broader market, this is only going to become an expanding opportunity. The investment universe is only going to broaden. And suddenly, when you're looking at the energy sector, industrial sector, finance sector, you want to be looking for some of these companies that are not just going to lose out and start to fall out of the picture because they were never competitive when it comes to enhancing their own tech capabilities. So I would say this makes a very strong case for why we think tech is a structural trend that is not going away. And I think it's also going to flow into this last slide that I spoke about, which is how some people see it as opportunity is nowhere, but we do think that the opportunity is now here when it comes to the tech space. So maybe with that, I see that we've come up to 7:30. I'm not going to steal Nikko AM's thunder. So with that, let me end my presentation here. Thanks very much for sharing your evening with me once again.
Thank you so much, Leonard, for the presentation and also for the answers to the various questions that our attendees have. So, right, next up, we do have a representative from Nikko Asset Management. So I have first up Esther, and then she's from the intermediary business development side, and then Greg, she's the portfolio manager for, and then both are from Nikko Asset Management. So together they will share with us, the story of global equities and why they should remain as core positions in our portfolio. So again, if you have any questions along the way, feel free to put them into the Q&A box and both speakers will get to them at the end of the presentations. So again, once again, I want to remind that due to time constraints, we are unable to answer all the questions and I have to apologize for that. So without further ado, let me pass over to Esther. Esther, please.
Thank you, 𝗜𝘃𝗀. Thank you for the introduction and good evening, everyone. I'm very happy to see so many of you on the webinar today. We're very pleased to have the opportunity to share with you about our outlook for global markets, how our fund is positioned, and what are some of the key investment themes that our investment team are keen on. So the fund that we are featuring today is the Nikko AM Global Equity Fund. For those who may remember, we had a fund called the Nikko AM Shenton Global Opportunities Fund, but last month, the two funds were merged and we have one global equity fund now, which is called the Nikko AM Global Equity Fund. Just to highlight to everyone that there is no difference in the investment team. Same team of fund managers who are managing the fund. Investment philosophy remains the same. Holdings of the funds are also the same. And also to highlight the fact that this new fund is also open to subscriptions via CPF OA. With that, I would like to just kick off with a short introduction to who we are at Nikko Asset Management. We are one of Asia's largest asset managers, providing high conviction, active and passive strategies across a range of equity, fixed income, and multi-asset strategies. And our total assets under management, $240 billion US. We do pride ourselves as being a global citizen with Asian DNA. We do have offices all around the world, including in Edinburgh, Scotland, where the team that manages the global equity team sits. And today from that team, and here you can see the whole team of fund managers that we have. From that team, we have one of the portfolio managers, Greg Bryson, who will be the presenter for today. Over to you, Greg.
Yeah, thanks, Esther, and good evening, everybody. Yeah, thanks very much for the chance to present our strategy to you. As Esther said, we've been the global equity strategy at Nikko now for, I think, just about 10 years at this stage. It's coming up to our 10th anniversary. And I'll talk a little bit this evening about, I guess, how we see the world, our philosophy and strategy, and how we're positioning the portfolio right now. So maybe just kind of starting with, I guess, some familiar territory for most of us. Last year was obviously a pretty fascinating year in capital markets. We saw after 60 years of money supply in the US only going in one direction, which was expanding, we saw the first tightening for 60 years last year as the Fed had one of the sharpest kind of interest rate hiking cycles in modern history. And that created a fairly unusual market backdrop for the market last year. And one of the outputs of that was investors increasingly crowding into visible, liquid growth stories. And within the market, those most visible, most liquid growth stories were very much in the technology space, in the Magnificent Seven. So 60 to 70% of market returns came from 7 stocks last year, which is obviously fairly unusual. I think one thing we would say is that in many cases, actually, that very strong investment performance was actually justified, because whilst the market or the market cap appreciation or concentration was high, so was the profit concentration. So whether it be because management teams had come to the end of enormous capital spending programs like Meta or Amazon, or because they are benefiting from the surge in new orders for all things AI related like Nvidia or Microsoft, these companies generated a prodigious amount of free cash flow generation last year. And that matters a lot. And as we touch on our process later on, you'll see that that is very important to how we invest our clients' money. I think one of the other factors of last year was that we all expected that monetary tightening at some stage to lead into a US recession last year, and that didn't happen. So as people got more comfortable around a soft landing in the US economy, that diminished the appeal of other defensive havens or other big liquid sectors within the economy, like healthcare, staples, utilities, and that just again added more fuel to the fire that was taking place in the Magnificent Seven. So that was last year, and to some extent it's going to continue into this year. But what we think is more important this year is, again, making sure that any appreciation in share prices is justified by improving business fundamentals. And you can see that when the stories of 2024 has been that there has been a bit of a divergence in fate for the Magnificent Seven, to the extent they've become somewhat of a more of a kind of famous five instead. With the Nvidias of this world continuing to drive better than expected earnings and sales, and that has driven their share price higher, whereas others like Tesla, the economic prospects have probably dimmed somewhat, and their share price has kind of started to reflect that dimming economic prospect, and the share price has been a bit weaker than the rest of the Magnificent Seven as a result. And whilst we very much concentrate on stock picking rather than macro, we thought we'd just basically talk a little bit about how we see the kind of macro at this stage as well. I think we still see a soft landing in the US is probably the base case, but I think it is important to note that that tightening in monetary policy that we saw in 2022 and in parts of last year, whilst it didn't have too much bearing on economic activity levels in the States last year, it does feel to us that it's beginning to have a little bit more of a bearing right now, and probably will continue to be a source of volatility in the medium to longer term for some companies. But we do recognize, I think, at the moment that we are in kind of relatively benign financial conditions, and the fact that bond yields are beginning to moderate recently somewhat is probably indicative of the fact that some of those inflationary pressures that we saw last year are beginning to kind of calm somewhat as well. So that's a kind of quick history lesson, if you like, and how we saw the market at the start of this year and the end of last year. So how are we planning to navigate these changing economic conditions? Maybe just skip on to the next slide, please, Esther. Yep, so our strategy is to basically find companies that we believe can grow profitably independent of interest rates or global liquidity levels. We deem them future quality companies, and future quality for us means looking for companies who are going to deliver high and rising returns on invested capital over the course of the next 3 to 5 years. We're looking for companies that are who are able to keep growing irrespective of the capital markets, where they have proven track records for continuing to innovate and to expand their competitive moat versus their competitors, irrespective of what's going on in the broader economy. And the reason we do this is because, not just because we think it sounds like a neat kind of catchphrase, it's because there's actually very strong empirical evidence that suggests that share prices tend to follow rising cash flow return on investment. And it makes sense, I think, as companies get better and keep growing, then they continue to attract more capital, and that's a kind of virtuous cycle, as opposed to the opposite, where companies become disrupted by new incumbents, their businesses start shrinking, they have less money to invest in future growth prospects, and again, that kind of turns into a more of a kind of vicious cycle. So our strategy is all about kind of finding those companies on that improving path. And all of our companies are on that journey, whether they start off as being recognized as good companies already, where I guess the kind of Microsofts of this world, which we've owned for a decade or so, those would always be recognised as good companies, but for a long time we had the view that the market was underestimating the profit generation of their cloud franchise. And I'm pleased to say that's very much turned out to be the case, and as that management team has taken that company on a real journey over the decade that we've been investing in it. But in those companies that are good high quality compounders are always the majority of our portfolio, but we do have some, I think we've got a couple of examples later on in the deck. They're on a journey of improving quality from the middle of the pack towards leaders. I think it's just important again to focus on that future nature of our philosophy, because there's just looking at historical quality is actually a pretty poor guide to future investment performance because of disruption, and we think that kind of rate of disruption is likely only going to accelerate going forwards. Maybe just move on to the next slide, please, at that stage. So yeah, talking about future quality, I guess, as I say, we look for the same kind of 4 characteristics we talked about earlier, the kind of franchise management and balance sheet and valuation, because we don't want to kind of pay for that future quality at any price. Being prudent Scottish people, we always like to have a good kind of valuation underpinning. And if our stocks have made the successful journey to that highest quality, or the first 2 quintiles of cash flow return on investment in the market, but they're valued as such, we won't continue to stay in those stocks. So that valuation discipline is actually very important to us in making as a kind of key underpinning to our strategy. Maybe move on to the next slide at this stage, Esther, just to keep things moving along. Great, so this is how we see the market looking as we kind of step into 2024, and just building on that conversation or the points we're making earlier on. We think that we're actually likely to be in a world where there is a great bit more volatility going forwards than has been over the course of the last decade, whether it be because interest rates are high and are likely to stay a bit higher than they have done over the last decade, or because of geopolitics. We think that sustained revenue growth and profit growth will actually become more and more valuable in this world going forwards. And even though the Fed's monetary policy tightening hasn't had a big impact on economic growth so far in the US, we think that that's partly because a lot of debt in the US was termed out and is long-term in nature, so refinancing requirements haven't actually presented themselves as a challenge yet, but we think that is probably still coming. But we are continuing to kind of find lots of companies in control of their own destiny, irrespective of those broader economic conditions. And they're in a broad array of sectors, not just in the tech sector, albeit we have been invested in tech this year with a few AI-related companies, whether it be the NVIDIAs, Broadcoms, Synopsys, TSMC, and Microsoft. Maybe just move on to the next slide at this stage. Perfect. So these are some of the kind of thematics that are at play in our portfolio at the moment. We've talked about tech, and we can certainly talk about that later on, but these areas are also very important to us, and one of the kind of hallmarks of our strategy over the decade that we've been investing together has been our ability to find these good future quality companies and source attractive or strong investment performance across a number of sectors. And at the moment we are looking for, I guess we continue to look for companies where we are parts of the market where we see compound structural growth, and the need to provide affordable, high-quality healthcare is very front of mind for all of us, and it certainly has been in recent years. I guess we're all familiar with the need for high-quality healthcare given aging societies and the rising prevalence of chronic illness. I think we're also acutely aware of the fact there isn't endless amounts of money to pay for that growth. So we're constantly looking for companies in our portfolio that allow us to deliver the highest quality healthcare as cost effectively as possible, whether that be through helping to discover and produce new medicines in large quantities as cheaply as possible through the life science tools companies, or by treating patients in the facilities that are actually best suited to give them the best quality care for the lowest possible price. And one of the examples on this slide here is 𝗪𝘃, which is a US company that provides specialist care for people recovering from strokes. And they've proven over a good number of years to be able to really harness technology to demonstrate that they generate cost savings for the US system whilst also delivering better healthcare outcomes for their patients. We'll talk a little bit about energy at this stage in the top right of this slide. We are very genuinely open to multiple different sources of energy. Our focus for us has been energy security and energy efficiency rather than being too focused on one particular form of energy generation. because whilst we recognise the merits of a long-term move to less carbon-intensive energy, we think that actually has some fairly significant inflationary consequences in the near term. So we very deliberately spread our investments in the energy space across different forms of energy generation, and tending to focus on companies that allow us to do more with the electricity that we, or the power that we already generate. And the companies, for example, like Schneider Electric. One of the other areas we're talking about here, I guess, is we've sourced that future quality, as I said earlier, from a broad number of sectors, and some of them are not necessarily traditional areas for quality growth managers such as ourselves to hunt, and financials has been a good example of that, where you can find good companies using the power of technology and data to unlock differentiated kind of long-term growth patterns. Those have been great investments for us historically, whether it be US insurer Progressive, who have helped to disrupt the auto and home insurance market in the US, or Palomar, who started off as an earthquake insurance business in San Francisco and have diversified from that, or Ryan Specialty. Those have all been good investments for us in that space for a number of years. And the final area we just wanted to touch on, the final thematic, was just the recovery in travel. I guess we've all seen that things have normalized post-COVID, but we still think that based on all historical analysis, as living standards continue to increase in the emerging markets, that kind of recovery from COVID will pass on to just higher growth going forwards as those people indulge in the same experiences that as people in the developed world have enjoyed for a number of years. And you can see there some of the beneficiaries that we have identified from that thematic going forwards. Maybe that's to just move on to the next slide, please, Esther. Cool. The next couple of slides, I think, just going to dive in a bit more detail into a couple of those stocks, and I'll spare you the reading out all of these points to you. But I think one of the beauties of Danaher, which is one of the biggest players in global life science tools industry, is the fact that they allow us to participate in one of the most exciting parts of innovation in healthcare, which is new drug discovery, but in a way which helps to reduce the binary event risk of just being invested in a biotech company A or B, whose success or failure will be dictated by whether a drug gets through the clinical trial or not. And I think the burn rate of clinical trials into finally approved medicines still remains very high, to the point that 9 out of every 10 new medicines that get discovered don't make it through to actually being approved through the clinical trial process. So we don't want to kind of minimize that binary event risk. And the way we do that is by owning the kind of picks and shovels of that discovery process. And Danaher, as I say, are one of the biggest players in the world in terms of providing some of the chemical analysis that allows us to characterize and make new drugs. And that, as you can see in this chart here, allowed them to deliver stable and rising cash flow returns on investment over a long period of time. And that's exactly the kind of hallmark of those kind of future quality investments that we look for as part of our philosophy. And that, maybe just one more stock example before we move on to the market. Thank you very much. 𝗲𝘰 again is another example of one of our plays in energy. So we like our companies, traditionally speaking, to be companies with good management teams who have a proven track record of investing when times get tough, and through doing so, I guess, never letting a good crisis go to waste. So this company obviously enjoyed a kind of good time when energy was actually, or companies were investing heavily in exploration and finding new resources, but that music stopped in 2013, 2014, and since then, as we've seen a decade of pretty significant underinvestment in new exploration and development for energy. And that's been a tough time for energy services or energy or construction and engineering businesses like 𝗲𝘰. But rather than kind of turn the lights off and get rid of lots of engineers, this company has actually done a great job in terms of continuing to invest through that down cycle. They've kept their engineers employed, and they've continued to bolt on new capabilities, so they can now play across the whole energy spectrum, from carbon intensive energy to greener forms of energy. And it's that diversification of future growth opportunities and real domain expertise, having kept all of their experienced engineers through the downturn, that we think positions them very well to enjoy a pretty rapid upturn in growth and returns as the market for exploration and development begins to normalize, as we're beginning to see in recent weeks and months. So Worley will be very much on that path of rising cash flow returns on investment, which we look for as part of our strategy. You can see that in our expectations and returns here, moving from low single digits up towards double digits over the course of the next 5 years. And actually, we think it could continue to be a good source of compound growth even after that 5-year period is passed. So those are just a couple of quick stock examples in terms of what the future quality philosophy looks like in practice. And maybe just move on to the next slide now, just for the, I guess, the conclusion, to make sure we've got plenty of time to talk about. Gone a bit, well, not the slide I was expecting to see, but I guess as you can see here, perfect, thank you. So we've been, as I say, we've been investing together for a decade or so across lots of different kind of sorts of economic conditions, all with that future quality investment philosophy. We think that finding those stocks that are actually in control of their own destiny is going to be increasingly important going forwards, given the challenges of more difficult geopolitics, an inflationary picture which looks a bit more complicated now that globalization seems to be going somewhat into reverse because of geopolitics. We think that as a result, the next decade or so is going to look a lot different to the last 10 years, where we've been enjoying ultra low interest rates and very abundant liquidity. So we think those hallmarks of future quality are going to be actually increasingly important going forwards, particularly those strong balance sheets and those strong management teams that allow our companies to keep investing in future growth opportunities and strengthening their competitive position irrespective of what's going on at macro backdrop. So as it says here, we think those companies are genuinely differentiated, and we think that's going to be a good source of compound growth for our clients going forwards. We think that focus on future quality rather than historic quality is actually very important, and it's that allied to our team approach and the kind of the way we invest our money for our clients, which has led us to grow our book of business fairly significantly over the decade that we've been investing together at Nikko, whilst generating strong investment performance. And as I say, we'd firmly expect that to continue going forwards in what we expect to be a fairly difficult decade, or a fairly volatile decade, I should say, going forwards. So those were the kind of prepared read remarks we had at this stage. I hope they kept that to 20 minutes, so we've got some time for Q&A.
Thanks, Greg. And yes, that was well within 20 minutes. And we do have quite a few questions that have come through. Maybe I can just highlight a few that you can take. I don't think we'll be able to take all, but we've had 2 questions actually asking about the upcoming US election. What would your view be on how it would affect markets? And I guess how would it affect the fund as well?
Yeah, thanks, Esther. I guess we don't pretend to be kind of political specialists, but what I would say is that whoever wins the White House, some of their challenges are going to be fairly obvious, and it won't make any difference, because the borrowing that the US has been doing over the course of the last 10-15 years, they're going to have to find a way of delivering growth in a kind of more budget effective fashion. So we don't think that matters whether it's Republicans or Democrats. One of the things that I think we are looking at, and one of the great success stories of the US historically, has been their ability to attract immigration into the country and kind of turn them into good economic wealth generators. So one of the things we would be looking at, and would be slightly concerning to us, would be if there were to be a meaningful change in US immigration policy, which might, I think, in turn lead to a tightening of the labour market in the US. And if we were to see an uptick in inflationary pressures because wages and that kind of wage spiral weren't coming under control in the US, I think that would limit the Federal Reserve's room for manoeuvre, and that might not necessarily be great for risk assets. But again, I think our companies and the hallmark of the companies we invest in would actually leave us relatively well placed if that were to happen.
Right. There's another question here that is asking about how would you be positioning the global equity fund to handle a market recession if it does happen?
Yeah, I mean, I guess it's certainly not our base case. We do think that certain companies with weaker balance sheets will be substantially in a weaker competitive position going forwards, because the need to refinance their debt is going to become increasingly painful for them over the course of the next 3 to 5 years. But those heavily indebted companies are not the companies we invest in. We are very much kind of focusing on those stronger balance sheets. So if anything, we would imagine that our strategy actually would fare relatively well in a recessionary environment. And that certainly has been the case in the past, where our strategy has delivered very strong investment performance in the event of market drawdowns.
Thank you. Well, there's a question here asking about AI. What's your view on AI, and are you actually investing in any AI names?
Yeah, I think we're kind of constructive on AI, and I think I guess, again, we always kind of come back to those historical analogies, whether it be mainframe computing, laptops, smartphones, all these kind of big steps forwards in IT architecture. Those cycles or adoption cycles have all typically lasted at least 10 years. And I think we can see how something somewhat similar might play out with AI. Our confidence in this one relative to some of the recent past is actually probably somewhat greater in reality, because the infrastructure build out in this case is actually being paid for a very strong cash flow generation by very profitable companies like Microsoft and Alphabet, and isn't being funded out of debt like was the case, I guess, in the internet revolution, where lots of mobile phone companies took on massive amounts of debt which they then had to service, and that limited their ability to keep spending when economic times got tougher. So I think the starting point is very positive, but we'd also, I think, recognize that at some stage in the next couple of years, we're going to need to see some real world kind of killer applications for this infrastructure if the spending is going to keep going. So we don't think we're necessarily there yet. We can see the kind of some tentative signs appearing in areas like new drug discovery and in energy and other areas that are represented within the portfolio, but we'll be very much looking for these applications to emerge over the next 2 or 3 years for that spending to keep going.
Yeah, that makes a lot of sense. Maybe you could tackle this question here, which you kind of spoke about a bit, but if you could share a little bit more about maybe one successful stock that you've held in the portfolio, how it's contributed to returns, and explain maybe the rationale behind holding that within the fund.
Yeah, I think one of our longest serving holdings actually is Microsoft, as I said earlier. We a long time ago recognized that company was on that path which we thought was likely to yield much more sustained, much less volatile profits, and that was as the company moved from its old heritage into a much more of a software and subscription business. And on top of that, obviously, we had the advent of the cloud and the move towards the kind of the hyperscaled cloud providers. And we very, very quickly recognized that we're companies that actually invested heavily in creating that architecture and had become indispensable to their customers. As the architecture got increasingly used, the profit generation would be enormous, because at some stage the kind of revenue growth or the sales growth would far exceed the amount of cost growth or investment growth the company were doing. And that's very much been our experience at Microsoft over the decade that we've held it. And that profit generation has continued to comfortably beat market expectations for a decade, which is actually pretty unusual, because in most kind of periods of time in history, it's very unusual for a company to stay at the top of its game or the top of its performance for as long as Microsoft management have done.
Right. There's a question that just came in, and I'm wondering if you can answer this one as well. What are the expected returns for the US market, seeing that, valuations are pretty high? Are there opportunities within, say, Europe and Asia that you see going forward?
Yeah. I must admit, I'd kind of typically step away from forecasting market returns. We think that it's fair to say at an aggregate level that valuation multiples look fair to us. So rather than focusing on a market level thing, we will tend to kind of focus on where we think our companies can actually generate better profit growth than the market currently expects, and would expect the share prices to track those better than expected earnings. And we certainly see parts of the market where that can be the case, and we talked about some of them earlier. Europe, and Asia, we are genuinely very global and focused. The problem we have is that, often speaking, when we look for quality growth compounders, the valuation multiples that we're being asked to pay for the same sustained compound growth in Asia and Europe is much higher than is the United States, because historically there's been a smaller supply of those genuine growth compounders in those regions, so they tend to attach a valuation premium relative to the US competitors. So we are looking and we like the space. We're not bearish on Europe particularly. We just find their valuation for genuine quality growth a little bit stretched relative to the US at present.
Great. Thanks for that. Just mindful of time, I think we've reached just a minute before. And with that, maybe I can hand the time back over to 𝗍𝘃.
Yes,
Thank you.
very much. Thank you, Esther, and thank you, Greg. So once again, thank you once again, Leonard, Esther, and Greg for the wonderful sharing tonight. I'm sure we have all learned a thing or two, and also a big thank you to everyone here who is with us this evening. So I do hope that you find the sharing useful in your investment journey in 2024, and are prepared to seize the opportunities that are coming in the second half of 2024. And yes, finally, we would like to invite everyone here to connect with us on our social channels. So on the screen are the links to our various social channels. Feel free to scan the QR code of the channels that you use often, and we will see you there. So with that, the webinar has ended, and have a great evening, everybody. Feel free to leave the room from now onwards. Once again, thank you very much for being here. And once again, thank you, Leonard, Esther, and Greg. Have a good evening, everybody.